In this video, I'll be discussing about infinite banking. What is it? How does it work? Who is it not for? And what product can be used to do it? Okay, what is infinite banking? Infinite banking is when you use the cash value of a life insurance policy to go do business, other business that will actually produce more return. And once you do that, you use the return from those businesses and put it back, at least as much as possible, back into your policy, a continuous process. How does it work? This is how it works. Let's say you have 5,000 in your bank account, 5,000 in your, let's stop kidding. Let's say you have 100,000 in your, let's say, whole life policy, and you wanted to borrow, at least you needed 90,000 to buy a real estate. It's an assumption, or buy something, do some business. So you go to the insurance company and you borrow 90,000 from them, and the insurance company will hold your 90,000 as collateral. Once the insurance company holds your 90,000 as collateral that you have in your policy, they loan you 90,000 and charge you interest. Okay, interest on that loan. The good part is that you didn't actually use your money. It's not really your money that you're using to go do the business. You're using the insurance company's money, because you're paying them interest, and the insurance company is using the money you already have in your cash value policy as collateral. So your money continues to grow based on they call it dividend. Some people call it dividend, or some people call it premium that is returned. Your money continues to grow at a certain percentage of what they promised you. Let's say 4%, and the loan that they gave you could be 4% too, or could be 4.5. So there's only a spread of 0.5. So it's almost a wash loan. Now, you're required to pay the insurance company back. That's the thing. You're required to pay the insurance company back. But since you took the money to go do business, at least we're expecting you to make money, that you can return back the 90,000 back into the policy and pay the insurance off, and your money still grows. How does it work? The most important thing in infinite banking is between the spread between how much interest you're being credited and how much interest you're being charged for the loan that you took. That is the most important thing. The rate of return depends on what you took your money to go do. That rate of return is there. Although some policies can, if you use like an IUL to do it, it may be linked to a stock market, but many of them advise don't use an IUL, but I believe you can do the same thing with an IUL. You just have to get the right IUL. That's all. Okay? Who is it not for? Now, a lot of people do not want to do not know how to work with money, because this policy is actually playing a spread game, a spread game between two interest rate. You're getting 6% and you're paying 4%. So there's a 2% spread between the interest rates that you're being paid and the one you're being charged. So it's a spread that you're playing. And if you're not really going to go use the money to produce more income or do a business, there's no point of you taking the money out. There's no point of you doing infinite banking if you don't know how to make your money work harder, make more income. If you don't know how to do that, please don't do infinite banking, because it's pointless. The only thing you'll be doing is maybe buy a car every year, and instead of have cash in your policy, buy a car. Instead of getting it financed, you finance it using your own cash value policy as the collateral. Your money keeps growing. Your money keeps growing, and you keep pulling the into the monthly payment back into your policy, back into to pay off the loan that you have with the insurance company. Okay. Now, if the interest rate that the insurance company is giving you is more than the interest rate that you're earning, then there's a problem. So that's why the interest rate spread is the most important thing in the infinite banking principle. You have to understand that. Okay. Now, what product can be used to do it? My perspective is that a whole life can be used to do it, as long as the whole life and the interest rate, not all whole life. You have to make sure that your money is not used. You're not pulling your own money. Actually, you're pulling the insurance company money and your money is only as a collateral. If the insurance company is taking out the money from the policy, it doesn't work. The infinite concept fails. Okay. Now, what product can be used to do it? IUL can be used to do it. Whole life can be used to do it. Most whole life people say, "Oh, IUL can be used to." IUL can be used to do it. Now, they both can be used to do it because you can choose fixed interest in some IUL. You could let it go with the market, the stock market. Some have caps, some don't have caps. Now, whole life, the same thing. Um, the most important thing is not the product. The most important thing is not if you use an IUL or whole life. It's more of, does your money keep growing inside the policy even after you loan out 90,000? Plus, are you able the money you loaned out, the 90,000 you loaned out, are you able to use it to produce more income? To produce more income to return that money back to the insurance company, and your policy grows even more because now you have an asset that is producing income back into your policy. So now, this is not the only concept there is. There's also one more that I just learned a couple of days ago, and they called it the flip. And this is done with an IUL. And how does it, what is the point of it? Watch the next video to find out.